People don't understand the Fed. They don't understand monetary policy. And by the way, the elites like it that way just fine. The average American probably thinks Federal Reserve is a brand of, aged whiskey or something. So, look, you understand it. I understand it. The Board of Governors understand it. Actually, they don't. They're not very good at what they do. But there's some experts and analysts and some members of Congress who do. But the creation of money is one of the great mysteries. It's actually not that big a mystery, except it is because people don't know how it works. So they're not held to account. They're also technically independent agency. The regional Federal Reserve banks in the U.S. are privately owned. They're owned by banks in the area. If you said who owns the Fed, I would say Bank of America, Citi, Wells Fargo, and JP Morgan, and a bunch of other banks. The Board of Governors are appointed by the president, but there's actually a vacancy at the moment. They have increased the money supply radically, but it really doesn't matter very much at this point because there's no velocity, there's no turnover of money. The Austrian economists, the neo-Keynesians, the monetarists, they all agree on one thing: that's if you create money, you're going to get inflation. Increase in money supply will be an increase in prices, etc. That's not true. It's empirically not true. Just go back to 2008. In 2008, the Federal Reserve balance sheet was $800 billion. Today, it's about $7.5 trillion. Even as late as 2015, it was $4.5 trillion. Where's the inflation? We don't have it. So that means that money supply does not correlate to inflation. The key to inflation is a serious problem, or will be, but the key to inflation is not money supply, it's velocity. It's the turnover of money. And the problem right now, are they creating money? Yeah, they're creating it like crazy.
Right.
But all they do is they give it to the banks to buy treasury notes. That's how they increase the money supply. They stick the treasury notes on the Fed balance sheet and they just sit there. The banks have the money. What do they do with the money? They give it back to the Fed in the form of excess reserves, and they get a little bit of interest on it. But the money doesn't go anywhere. It's the lending, the spending, the increase in basically the turnover of money that could give you inflation, but we don't have that. Why? Because people are scared. They're, if you lost your job or your business shut down, you're not spending. You're either paying down debt, you're paying bills. But when you pay bills, that's not spending. That's just reducing your balance sheet. Spending is like going out and buying dinner or Christmas presents or a new car or something. People are not doing that with very few exceptions. So, and the banks aren't really willing lenders at this stage, except to certain sectors. So you're not getting lending and spending, you're not getting the turnover, and therefore you're not getting the inflation. The money is just piling up and it's not going anywhere. So for now, the increase in the money supply doesn't mean anything. That could change, but we have to watch for that. Well, gold is getting a bounce, but it's getting a bounce for other reasons. When people say, is the dollar going up or the dollar going down, they look at the euro-US dollar cross rate, or they look at the dollar-yen cross rate, et cetera. And I tell people those measures are meaningless because, if you're in the export-import business, you care about the foreign exchange rate. But all the major currencies, the 7 or 8 major currencies that make up the IMF Global Reserve Report, they're all passengers in a lifeboat. They're all survivors in a lifeboat. Some may be taller, some may be smarter, whatever, but they're all in the same boat. They're all going to sink or survive together. The only way you can understand what's going on in currencies is compare it to gold. And so when the dollar price of gold goes up, I just say, well, that means gold doesn't change. It's atomic number 79. It's an element. It's the same thing. If the dollar price of gold is going up, that means the dollar is getting weaker. If the dollar price is going down, that means the dollar is getting stronger. So if you want to forecast gold prices, you have to ask yourself, is the dollar getting stronger or weaker? And then that's a pretty good basis for making a forecast. But the difference between gold and all the other currencies is gold, of course, is the only one not printed by a central bank, not subject to manipulation as the supply. There is new supply, but new supply has been static at about 300 metric tons per year for the last 5 years. So that's not expanding dramatically. And that's a very small, it's about a 1.6% increase on the global above ground supply. So that's not a big number either. But gold is your thermometer to tell if the patient is sick or not, the patient being the dollar. The worst thing you can do in any asset class is go all in on anything. Diversification is the key. Most people don't understand diversification. They think if they own 30 stocks in 10 sectors, they're diversified. And I say, no, you're not. You've got one asset class, okay, and they're highly correlated. So I wouldn't get all out of equity. I would lighten up on equities. I would increase my allocation to cash, because cash reduces volatility in your portfolio. And I would absolutely have 10% of investable assets in gold, silver, or gold mining shares. Now, some people say, well, Jim, if that's the way you feel, why not go all in? Why not 50%? You know, but that's up to you. I don't recommend those kind of high percentages. You don't need them. If I'm right about the price of gold going to $10,000 to $15,000 an ounce in the coming years, 10% allocation is going to do just fine. Now, that's going to save your portfolio.